If you've ever attempted to buy whole life insurance, you no doubt were presented with a long document filled with lots of words and lots of numbers, and we in the industry call those an illustration. Today, we're going to walk through what a whole life illustration looks like and what all the information in it means so that you can better understand what is being presented to you when you attempt to buy a whole life insurance policy. Hi, I'm Brandon, founder of the Insurance Pro Blog and licensed insurance agent. And one of the most confusing things about purchasing whole life insurance or even looking at an in-force whole life insurance policy is the illustration, the document that we use to try and explain the mechanics of the policy that is being proposed. This is a fairly lengthy document that has a lot of information in it. All of it's fairly important, but there are certain pieces that are more critical when it comes to understanding exactly what's going on. So the life insurance illustration is an effort by the insurance company and the insurance agent to illustrate, if you will, the functionality of the life insurance policy in question. And it does attempt to show how values will accumulate over time. But this is not a projection in the sense that we can make up or down modifications to assumptions of the policy to give you a better understanding of what will happen under certain economic circumstances. There simply isn't enough granular control to take into account various things that might happen to give you that sort of granular projection on how various things might impact a whole life insurance policy. It can, within certain limitations, show you how changes in the dividend payable by the insurance company might impact the accumulation of cash values and death benefit, but just understand that there are an array of limitations to what can be assumed here outside of a projection that shows you what the current dividend is capable of doing, what some reduction to it, though we don't understand exactly what might drive that specific reduction would do, and then, of course, what would happen if the policy never earned a dividend, which is definitely a reliable projection since that is the contractual guarantee of the policy. Life insurance illustrations are created by insurance companies, or insurance company software, I should say. They are coded by data that the insurance company has compiled through its actuaries to show how policies should unfold under current circumstances. Current circumstances being, in the case of whole life insurance, the present dividend scale announced by the company's board of directors as of the last announcement, usually taking place sometime in the latter part of the year. Illustrations are deemed important for the sake of selling and marketing life insurance products, and there are regulations that govern what illustrations must show you, the buying public, as a disclosure from insurance companies and insurance agents. Some, not all, but some of the most critical components that illustrations must contain for you are the name of the insurance company and the agent who's presenting the policy to you, the product specifically that is being proposed, the insured's information, including their name, their gender, their age, and the underwriting risk class that is being assumed for this particular proposal, the death benefit, the original guaranteed death benefit of the whole life insurance policy, and the dividend option that is being chosen to project values of the life insurance policy in the future. There are also things that are not allowed in illustrations. So first, the illustration cannot refer to life insurance as anything but life insurance. So even if the agent attempts to tell you there's some special whiz-bang thing going on here and they don't quite mention life insurance, the illustration must mention that this is a proposal for the purchase of a life insurance contract. All of the pages that are standard to the insurance company's disclosures must be included in the illustration. So if there is information that the company or the agent would rather not show you, they do not have the luxury of simply omitting those pages. The pages must be numbered so that somebody can verify that all pages are in fact present. The illustration cannot confuse guaranteed and non-guaranteed aspects of the policy and must clearly state and call out the features of the policy that are guaranteed and the ones that are not. The illustration cannot suggest that a policy will become paid up unless the features that are making it paid up are contractually guaranteed features. And if the policy shows any kind of modified premium schedule that is not part of the original contract's premium payment timeline, the illustration must note this and disclose this to the individual who's considering the insurance purchase. And lastly, the illustration cannot assume anything that is beyond the current capacity of the insurance company issuing the policy. What that means is, if the insurance company's current dividend scale is X, but you want to know what would happen if the dividend scale went up to X plus some number, the insurance company cannot run a special illustration that shows you what that scenario would look like in terms of cash accumulation or death benefit growth over time. The only adjustment that the insurance company can make to the dividend is downward, not upward. Now, having said all that, let's look at some real illustrations so that we can walk through some of these components and give you a better understanding of how to actually read one of these documents. We have here in front of us a standard whole life illustration from an insurance company, and we note the insurance company's name. You'll also see down here information on the insurance company as well as where it's located. This section right here is where the agent information would fall. Since this is going to be a video that lives on the internet theoretically forever, I decided I would omit personal information like phone number and address for me. But just understand this section here is where things like address, phone number, email would all exist in the illustration. Here on the next page, we see where the proposed insured's name would go, their gender, their age, and the risk class that was assumed in putting together this particular proposal. Now, this section right here is showing us where the money goes. So when you pay a premium to the insurance company, how that premium is being broken down into various components of the whole life insurance policy. First, we'll look at just the base whole life premium. So for a $1 million death benefit, this particular insurance company is going to require $14,770 be paid annually for a male who is 35 years old and assumed at the preferred non-tobacco risk class. Then we have a few riders that were added to the policy. One of them doesn't have an expense to it, but the other two do. First, an option to purchase additional life insurance without medical underwriting, and a disability waiver that would waive the premiums due if the insured under the contract were to become disabled, sick or hurt, and unable to work. Those costs are expressed right here. Adding them all up gets us to $15,634. That's the annual premium that would be required by the insured by this particular insurance company. Immediately following this section, and going on for several pages, is a narrative summary of the various aspects of the policy. So first, we see things like a description on the various riders that are associated with the policy. We also see what the product is. In this case, a whole life policy that's paid up at age 99. Oftentimes, we'll see information about loans and how those loans work when available on a policy. We also have a section that speaks to what the premium will be if the insured decides to pay under some different frequency than annually. Much like auto insurance, if you pay insurance premiums less frequently than annually, there is an additional expense that is associated with that. So for example, $15,634 is what the insured must pay for the death benefit and the various riders if paying annually. But if choosing to pay monthly, $1,341.91 will be the premiums paid on a month-to-month basis. And times 12, that comes out to $16,102.92 that would ultimately be paid on an annualized basis if the insured were paying that monthly premium versus an annual premium. Another disclosure that whole life policies have is the interest adjustment indices. So these are a way of quantifying the cost of carrying the policy expressed by the premiums paid, the death benefit achieved, and the cash value that will accumulate up to a certain point. And 10-year and 20-year are the standard timeframes that are analyzed. These are fairly archaic measurements of life insurance policies, but the one important zoomed out thing to know is the lower the number, the better the deal for the purchaser. And you can, provided that you're looking at the right interest adjusted index, compare one index to another company and make an evaluative assessment on overall benefit. So if, for example, we were to look at another whole life policy for $1 million of death benefit, and it had a surrender cost index after 10 years of something less than 5.71, that policy is, under that analysis, giving us a better deal than this particular company is. But there are a lot of assumptions that are going into that analysis, and there are things that might be important to the prospective buyer that are not being factored into that analysis. So I would caution you against looking at any of these interest adjusted indices at one company versus another and flatly deciding that because the numbers at one are always lower than the numbers at another, that means I should go with the lower number since that's the better deal to me. You need to know what specifically is being assumed in those interest adjusted indice calculations. They're primarily focused on the premium paid, the death benefit that's achieved, and the cash value that was accumulated, and decide if those factors and how they go into the analysis really matter for you. Now let's look at the thing pretty much everybody came here to get more information on, and that is the ledger, the attempt to delineate how values will accumulate in the whole life insurance policy. The way the ledgers are presented is going to differ a little bit from company to company, but they're all going to have a lot of the same basic information in them. In this particular case, we have a guaranteed set of columns and a non-guaranteed set of columns. So when it comes to whole life insurance, guaranteed means we're not assuming any dividends, and non-guaranteed means we are assuming the dividend. And though I've written on it a little bit here, we can see on this ledger, it is telling us the dividend option chosen is the option to purchase paid up additions. This being a whole life insurance ledger, one of the most looked at features of whole life insurance is dividends, and we can see a projection of how dividends will be paid on this particular policy over time. But there's something I want to call out here that is important to understand for anybody considering a purchase of whole life insurance. Mechanically, whole life insurance policies are supposed to gain a certain degree of additional dividend as time goes on, which represents the money that has been paid to the insurance company by the insured. In other words, you're gaining sort of a bigger and bigger stake in the company because you are a longer standing customer. When the dividend scale is assumed constant in all years, this will result in an ever increasing dividend payable on the policy. But if the dividend scale at the insurance company is reduced, that could result in a dividend payment that is not higher in the current year than the previous year's dividend payment. So, for example, let's go to year 6, where the dividend payment is projected to be $3,416. That assumes that the dividend scale remains exactly the same as it was in year 1 through year 6. If, for example, the dividend scale does remain constant through year 5, but in year 6 is reduced, that could result in a dividend payment that is less than the $2,998 that was earned in the year prior. So while mechanically it is true that the dividend is going to increase by some amount each and every single year, the net payment of dividends may go down if the dividend scale itself decreases. Next, I want to call your attention to cash value and death benefit and speak to something that often confuses people when it comes to whole life insurance policies. We'll look, for example, at year 5, where we have accumulated $35,874 in cash value. We'll also note that there is a $1,030,585 death benefit reported in that year. The confusion that commonly happens in this case is, well, if I die, do I just get the $1,030,585, or do I get that plus $35,874? And the answer is you get $1,030,585. Keep in mind that the death benefit column is always showing you what the net payable death benefit is upon death in that specific year. It's including everything, the accumulation of paid up additions and any outstanding loans on the policy. So that number that you see in the death benefit column has already made any additions or subtractions to arrive at what the net payable death benefit is to your beneficiary. Now, some people might look at that information. I have $35,874 of cash value, but my death benefit's only $1,030,585, which means the insurance company is keeping somewhere close to $5,000 of my cash, and think, well, I don't really like that. What you should keep in mind is that when it comes to the accumulation of values in a whole life insurance policy, the cash value will be kept by the insurance company at death, but the death benefit will grow provided that the whole life policy earns dividends and those dividends are purchasing paid up additions. That's what causes the increasing death benefit that you see going on in the case of this policy. And you will notice if we go down to, for example, year 25, that we have $637,324 in cash value, but our death benefit now is $1,668,497, which means we have more death benefit that will be paid than there is cash value plus the original $1 million death benefit. Now, I think this would be a good moment to explain some mechanics about paid-up additions and how they influence death benefit and cash value, because we have the ledger in front of us and we can see how these things unfold mechanically over time. So if we look at the ledger and we look in year 2, we see the dividend payable is $1,980. We'll see that at the end of the year, the death benefit is $1,1,980. We also see that the cash value is $1,980. If we go to year 3, we'll see that there is a $2,326 dividend. The death benefit, though, has risen to $1,010,454, and the cash value has risen to $9,915. Here's how this all comes together. In year 2, when this first 1980 dividend gets paid, that is added to the net death benefit. So if the insured died here, they'd have an additional $1,980 that would be paid on top of the original $1 million death benefit. But paid-up additions have two very important aspects to them. One, they create cash value, immediate cash value in the whole life policy, as you saw from the cash value column growing by $1,980 when there was a $1,980 dividend paid. They also create death benefit, and that death benefit is some multiple of the dollars going in. And that's why starting in year 3, we see an additional death benefit beyond just the value of the dividend that was paid, because now we're seeing the death benefit that got created by that dividend when it was originally paid. That $1,980 of dividend creates some multiple higher of death benefit. And if we look at the death benefit that was created, the dividends that were paid, we would come out to a factor of somewhere around 4 times death benefit created per dollar going into the paid-up additions rider. But how do we get to $9,915 when we've definitely not received anywhere close to that amount of money in dividends? The answer comes from this guaranteed cash value column. Notice that it has gone from 0 to $5,550 in year 3. The total cash value of the whole life policy is simply the guaranteed cash value accumulation plus any accumulated cash value created by paid-up additions. So if we look at the guaranteed cash value column at $5,550, and we look at this cash value of all adds column at $4,365, that's what gets us to the $9,915 of total cash value in the whole life policy. Now, you might look at this ledger, and you might look at the accumulation of dividends through, say, year 5, and look at the total of cash value of all adds, and realize that these 4 numbers added up do not equal $10,334. They actually equal $9,936. So why is the cash value of all adds higher than the sum of the dividends paid? The answer is guaranteed interest. Paid-up additions, or the cash value created by paid-up additions, earn the guaranteed interest that is promised under the contract of the whole life insurance policy. So paid-up additions will increase the dividends that are payable on a whole life insurance policy. You'll see that expressed by the dividend column. But they'll also earn guaranteed interest that is basic to the whole life insurance contract. And for that reason, the column that shows us all of the accumulated cash value created by paid-up additions and or dividends, as we would say, will be some number higher than simply the sum of dividends earned, because the guaranteed interest must be factored in as well. Also, I want to call your attention to the premium column, or the net premium column. So this column right here is showing us what the premium of the policy is, given the death benefit that was originally put in force as whole life insurance, the $1 million, plus the riders that were attached to the policy, the option to purchase additional insurance and the waiver of premium rider. Notice that at some point in the future, year 15, the premium goes down on this policy. And if we scroll a little bit further down to year 31, it goes down yet again. And now it actually equals the base policy premium, which is just the premium for the $1 million of death benefit. The reason we're seeing the premium go down is because the riders that were attached to the policy at issue are expiring. So in year 14, the rider that gives us the ability to purchase additional life insurance goes away. And that's the last year we'll pay a premium for that rider. After that, it goes away, and our new premium is adjusted to reflect the fact that that rider is no longer available to us. And then once we get down to year 31, the waiver of premium rider has expired in the prior year. And as a result of that, we now are only paying a premium for the original $1 million death benefit, no additional riders because they have expired. Now let's look at another illustration from another company, just so we can see how they differ a little bit and also give you a better understanding of some of the other columns that may be present in certain illustrations, but not always in every single one of them. To begin, we'll note that we have all the same basic stuff that we saw before: the product type, the company that's issuing the policy, the agent's information, which again, we've taken out since this will live on YouTube and I don't need people calling me or emailing me randomly, and information about where the company is located, as well as the insured's information, the name, the gender, the age, and then if we go down to the bottom page here, we also see the risk class that was assumed for the particular proposed insured. And like we saw last time, a breakdown in the premiums, where the money's going. We have all of the same riders assumed here. So the option to purchase additional insurance plus a disability waiver that is part of the policy. And when we add those up, we get the premium that is required by this company for this particular policy of $1 million and a paid up date of age 100 instead of age 99, because some companies just do it a little differently. So this ledger shows us the guaranteed columns and then the non-guaranteed columns. Again, one assumes there is no dividend and one assumes there are dividends. And we see a lot of very familiar columns here, things like the contract premium, the total cash value that has accumulated in the policy, the dividends that will be earned, the death benefit outstanding on the policy. And we could go through these numbers and find that functionally they work pretty much the same as we saw in the other example. One potentially notable difference here is that the death benefit changes a little bit here from the way it worked with the other policy, where we saw the dividend added to the death benefit in year 2. In this case, we're seeing the effect of the paid up additions on the death benefit in year 2. And for whatever it's worth, this particular policy is giving us slightly more death benefit per payment of paid up additions than the other policy was, at least in the very beginning. This particular company separates the cash value created by paid up additions and the death benefit created by paid up additions. And it's easy to confuse those two at times and sometimes assume that you're getting more cash value than you really are. So when companies do this, you do want to be a little careful about semantics here to understand if you're looking at a report showing you cash that is associated with paid up additions or death benefit that is associated with paid up additions. Now, one thing to note on the subject of, well, what happens if I die and I have X amount of cash value and then I have Y amount of death benefit? So we'll use year 5 again as an example. We have total cash value of $32,909. We have death benefit of $1,025,943. So original death benefit plus paid up addition death benefit does not equal total cash value that is accumulated plus original $1 million death benefit. And on this particular policy, it never will. So I wanted to call that out because it does happen in a lot of cases, but it is not actually a guaranteed functionality of whole life insurance. So I don't want you to walk away from this thinking that in the future, it'll always be the case for a whole life insurance policy that earns dividends, that death benefit will grow through paid up additions to a point where the original death benefit plus those paid up additions will always be more than the cash value that accumulates in the policy if it were stacked on top of the death benefit. That is not absolutely a guaranteed functionality of whole life insurance. It does happen a lot of the time, but it is not guaranteed and it will not always happen in all situations. The other noteworthy column here is this total paid up insurance column. This is different from that last ledger that we looked at, and there are some insurance companies that do include this as part of their illustrations. The purpose of this, the information that you can take from this, is what death benefit would remain outstanding if you were to put the policy into paid up status sooner than its contractually guaranteed paid up date. So whole life insurance come with 3 basic non-forfeiture benefits. We don't need to get into all of the details of what that means today. Just understand that they are representative of accumulated value that happens by virtue of paying the premium that you do for the years that you pay it. And one of the non-forfeiture benefits is to transition the policy into paid up status sooner than it was contractually guaranteed. And the particular ledger that we're looking at right now, this is for a policy that is guaranteed to be paid up at the insured's age 100. But you do have the option on all whole life policies to make the policy paid up prior to that date. What you will sacrifice in doing it is some of the original guaranteed death benefit. So what's happening is the insurance company is figuring out how much of the original death benefit is taken care of by virtue of the premiums that you have paid and can therefore remain in force. So for example, look at year 2. We've made 2 premium payments of $13,495. And if in that year we wanted to force this policy into paid up status, you would walk away with a death benefit of $5,300. That is the insurance company saying, hey, you paid us 2 payments of $13,495, and for that, you are guaranteed to always have a death benefit, if you wanted to, of $5,300. It's actually technically $5,301. There's some rounding that's going on here because it's basically all of the paid up addition death benefit that has been created at that point. But I want to explain that this total paid up death benefit amount is a function of premiums paid that are attributed to the original guaranteed death benefit plus any paid up additions that are earned up to that date. So at year 10, our outstanding paid up insurance amount is $368,355. What this is telling us is we have, if we look at the paid up additions column, $85,670 of paid up addition death benefit. And then, not easily expressed in this ledger, but if we simply deduct $85,670 from the $368,000, we'll have $282,685. That is basically a prorated amount of our original $1 million death benefit that remains in force if we put this policy into paid up status because we paid $13,495 for 10 years. If the particular ledger you're looking at does not have this column available, you can always gather the information on what sort of death benefit would remain outstanding if you force the policy into paid up status, either by getting a scenario that assumes putting the policy into paid up status at some date, or by calling the insurance company for an in-force policy and asking what the outstanding paid up insurance amount is on the particular policy. People who are looking at whole life insurance illustrations often want to know, is the accumulation of values a good deal relative to maybe other things I could do with the premium? And that's a really tough question to answer when we don't have a lot of other context outside of flatly, is it a good deal? It is the case that for whole life policies, over time, you will have more cash value than you paid in premium, and you'll always have more death benefit than you paid in premium. But the amount of additional cash value that is built up over premiums is dependent on the policy and also dependent on various design features. Some will definitely be better deals than others. And today, my intentions are really not to argue for or against the use of life insurance or whole life insurance as a cash accumulating vehicle, just to explain the mechanics. But we can go back to this ledger and we can look, for example, at year 20 and see that we have accumulated at that point $351,981 in cash value. If we add up all of these premiums paid, that is $267,695. So we do have more cash value than we paid in premiums. We do have a positive rate of return on this particular whole life insurance policy. We also have $1.3 million of death benefit outstanding on the policy. Whether or not you think that's a good deal really depends on your circumstances and your expectations as far as what you're looking to accumulate in a safe or risky asset. Safe being where whole life insurance is categorized. It is possible to get a breakdown internal rate of return report generated on a life insurance ledger, at least one at inception. And perhaps at a later date, we'll dive into exactly what that means and how to interpret one of those. But the key things I want you to take away from today are: net death benefit is net death benefit. Cash value is not added to the death benefit that is payable upon death. Dividends are designed in general to increase in terms of the net payable dividend to you over time, but that is not a guaranteed result because dividend scales could decline, resulting in a lesser dividend payment this year than you received last year. Premiums can change a little bit if you have a rider attached to your policy because the rider could expire and you would no longer have to pay for it. There are certain disclosures that are required in a whole life insurance illustration. There are certain things that cannot be included. The document is intended to give you an understanding of functionality, but it is not supposed to be an exact roadmap that you look at each and every single year to figure out where your cash value or death benefit will be. It'll give you a rough approximation of where you should be in the neighborhood, but not the exact figures. And you can take the illustration from one company and another and make comparisons so long as you know specifically what you are comparing from one company to the next. And that sort of analysis does require a certain amount of understanding of what your objective is when it comes to purchasing life insurance and what's more important to you, the accumulation of death benefit or the accumulation of cash value, for example. But hopefully now you have a little better understanding of how to interpret and read these documents. Thanks, and we'll see you next time.